Welcome to Life Insurance Basics. What is life insurance? What can and what shouldn't it be used for? And what are the different types of policies and how to know which one is right for you? Today's topic, Life Insurance Basics. Life insurance. Pretty simple product, pretty simple concept, but it's made complex and really needlessly so. So the topic of today's video is life insurance, the ABCs, what you need to know about life insurance. The first thing to keep in mind with life insurance is its purpose. Its job is to provide a lump sum of tax-free cash at time of death. So that really brings us to our first point of life insurance. If you don't need a lump sum, tax-free bit of cash at time of death, then maybe life insurance isn't the right thing for you. Now, when it comes to the reasons why you might want to have a tax-free lump sum bit of cash at the time of death can be numerous. It could be to pay debts. It could be to replace a lost income. This is sometimes referred to as human life value. Or it could be used to pay death taxes. The state and the federal government both have a series of taxes that are due at time of death. So when it comes to life insurance, there's many different choices out there, but it really falls down into a couple of basic categories. You've got your term life insurance, which is you pay a monthly premium for coverage for a period of time, for a term, a limited term. It's like renting an apartment. You don't actually own the policy for the rest of your life, like some type of permanent policy, but you have it for a specific time period. This is particularly useful if it's for something like paying of a debt. Over time, as the debt gets paid, the need goes away. So term insurance is very appropriate in those situations. But when it comes to paying taxes at time of death, well, that's a need that could always be there for you. So you might want to look at some type of permanent insurance. And this is where it can get a little bit overly complex. But don't worry, we're going to keep it simple for you. There's 4 basic types. The first being a whole life policy. With a whole life policy, you as the insured bear no risk in terms of the performance of the cash value. A universal life policy is another type of permanent insurance in which you as the insured bear the risk of how much interest the cash value makes. Over time, the cash value will be credited more or less interest with what's going on in the economy as to whether or not interest rates are higher in the economy or lower in the economy. So you as the insured are taking on the risk of changes of interest rates. The next level of complexity with a life insurance policy is a variable universal life. With a variable universal life, you're taking on the risk of the performance of the cash value, and the cash value is invested in sub-accounts which are like mutual funds. In other words, you're playing the stock market with your cash value. If the stock market does well and your sub-accounts do well and it brings your cash value up in a hurry, well then you benefit from that. But if the stock market does poorly, your sub-accounts do poorly, and your cash value declines accordingly, well then you bear the risk of that as well. The fourth and final type of permanent insurance is indexed universal life. An indexed universal life policy is similar to an indexed annuity in that you earn interest based upon the performance of the stock market index, usually something like the S&P 500. When the S&P 500 increases in value, you have interest credited to your cash value. But when the S&P 500 decreases in value, then you no longer have interest being credited to your cash value, but you're not bearing the risk of an actual loss. The risk that you are bearing with an indexed universal life is there is a need to build that cash value and have growth over time. And if the growth is less than what was forecasted, that's the risk that you're bearing. With permanent life policies, there's 4 types. There's the whole life, in which you take no risk of interest. There's the universal life, in which you take the risk of interest rates. There's the variable universal life, in which you're risking your cash value in the stock market. And then there's the indexed universal life, in which you're risking that you'll at least get a certain growth rate, but you're not risking a loss. So when it comes to life insurance, and it comes to some type of permanent insurance, you do have those 4 different choices. And if you're not sure which one is right, that's a great reason to pick up the phone or email us or reach out to us in some regards to get some clarity on which one might be right for you.